We constantly hear about the stock market's daily ups and downs, right? But beneath all that noise lies a much larger, highly engineered planetary ecosystem that you actually interact with every single day. Welcome to this explainer. Today, we are uncovering the deep systemic mechanics of global markets and revealing the universally standardized blueprint that is quietly driving literally trillions of dollars across the globe. To really picture this, I want you to imagine holding two completely different bond certificates right in your hands. On one hand, you've got a U.S. government bond, short-term, 2-year maturity, offering a 2% coupon. On the other hand, you have a corporate bond from a massive global company offering a high 7% yield over 30 long years. Now, on the surface, they look completely different, right? Different risk, different purpose. But here's the wild part. Beneath every single bond ever issued, whether it's U.S. Treasuries, UK Gilts, Indian G-Secs, or corporate debt, lies the exact same hidden architecture. It's built on just 3 numbers. And these 3 values quietly determine how trillions flow, how nations get financed, how corporations raise capital, and how investors measure risk. Now, before we break down this multi-trillion-dollar planetary ecosystem, please note, this video on the channel Blocks Bonds Funds is created for educational and informational purposes only and does not constitute financial or investment advice. All right, let's dive right in. It brings up a really simple but kind of unsettling question, doesn't it? If just 3 numbers define literally every bond on Earth, why do most investors never truly understand them? Well, think of it like blockchain. You can't grasp the whole thing without understanding layer 1 architecture. Fixed income markets have their own foundational layer. When a single bond contract unfolds into a glowing financial blueprint, it reveals face value, coupon, and maturity as the structural DNA of the market. Every bond, regardless of its issuer, size, or purpose, is engineered from this identical blueprint. So let's look at our first structural pillar, face value. In corporate bonds, you'll usually see this represented as a nice, clean $1,000. This number is the absolute foundation of the contract. It's the direct link between the investor and the issuer. It is how governments and corporations raise their capital, and it's how investors secure their firm repayment rights. Basically, it's the exact principal amount that the issuer contractually agrees to pay you back on the maturity date. Now, here's the crucial takeaway. Face value is the ultimate promise of repayment. Out in the secondary market, bond prices are quoted as a percentage of this par value. So if you see a quote of 95, it means the bond is trading at a discount, or $950. A quote over 100, it's trading at a premium. But listen, regardless of whether a bond is trading at a premium or a discount because interest rates are jumping around, it will always mature at its exact par value. The market price fluctuates all day long, but that face value remains a static, unyielding promise. Moving on to our second pillar, the coupon. Watch how this completely transforms a static piece of paper into active digital cash flows. The coupon is just the issuer's contractual interest obligation. For your standard plain vanilla bond, this is a fixed rate, meaning you get constant, predictable payments over the life of the bond. But there are also zero coupon bonds. These don't pay any periodic interest at all. Instead, they're issued at a massive discount, and your interest is simply the difference between that cheap purchase price and the full face value you get at maturity. And then we have something brilliantly engineered, the floating rate note, or FRN. For these, the interest dynamically adjusts. The coupon is calculated using a floating benchmark rate, say the Mumbai Interbank Offer Rate, or MIBOR, plus a constant spread measured in basis points. Quick reminder, 1 basis point is just 0.01%. This dynamic setup is absolutely amazing for protecting investors. Why? Because as global interest rates shift around, your coupon payment automatically calibrates to the current market environment. Pretty smart, right? All right, let's hit our third pillar, maturity. This builds our flowing timeline. Maturity is basically your repayment horizon. It dictates time. This timeline stretches all the way from short 4-week Treasury bills and commercial paper, right through 10-year Treasury notes, and all the way out to 30-year corporate or sovereign debt. By tweaking this one single number, issuers can perfectly align their financing with the exact lifespan of whatever project they're funding. That could be a quick operational bridge loan for a few months, or a massive infrastructure build taking decades. Now, this maturity timeline actually creates a strict dividing line in the global financial ecosystem. it splits it into two distinct domains. Securities issued with a maturity of 1 year or less, those are money market instruments. But anything with an original maturity longer than a year scales right up into the capital markets. It's a hard boundary that dictates who treats these things, how they're regulated, and exactly what kind of risk they carry. So as this timeline and those other variables shift, the entire bond transforms. The cash flows, the pricing, the yields, the duration, the risk, it all originates from this exact interplay. But here is where things get really interesting. Face value defines the principal. Coupon generates the income, and maturity governs the time. If these three static pillars just make up a basic legal contract, how on earth do they power a dynamic, continuous global market? I mean, before a bond even reaches your portfolio, an intense process of financial architecture has to take place. Who is actually engineering these numbers before they hit the market to ensure they succeed? Well, that engineering process starts way before issuance. Corporate treasury teams or government finance departments have to meticulously balance their own need for capital against what investors actually want right now. And they don't do it alone. They bring in an underwriter and work alongside legal advisors, regulators, and rating agencies to deliberately design that principal, coupon, and maturity. The underwriter is absolutely crucial here. They provide strategic input on the current investment climate, set the coupon rate, figure out the tenor, and prepare those massive legal prospectuses that detail the investment terms. Now, for truly massive global issuances, one single investment bank just can't shoulder the load. So a lead underwriter coordinates what's called a syndicated offering. They invite a whole group of investment banks to join forces. This syndicate takes on the immense risk of buying the new bonds directly from the issuer at a negotiated price. Once they own them, they use their massive global networks to resell and distribute those bonds across the entire planet to pension funds, insurers, mutual funds, banks, depositories, and exchanges. Once it's finally launched, the bond's active life cycle unfolds. See, it's no longer just a static certificate. It's a living, active, contractual relationship. It moves from that initial issuance and settlement right into a predictable rhythm of coupon payouts. And crucially, it enters the secondary market for trading. Here, bonds can be traded at a clean price, which ignores accrued interest, or a dirty price that includes it. This capital just keeps circulating right up into the final stage, redemption. That's when the face value is returned and the contract is officially fulfilled. Yet, with literal trillions of dollars flowing so rapidly through this highly interconnected network every single day, we have to ask a pretty vital question. What stops this whole financial system from just collapsing if an issuer suddenly goes bankrupt or refuses to pay? I mean, there has to be some kind of invisible legal shield holding the architecture together, right? Exactly. Beneath the surface, there's a rock-solid, invisible legal framework. You've got prospectuses, disclosure rules, regulators, and courts all surrounding the contract. But the enforceable core of it all is the trust deed, also known as the bond indenture. This governing legal document is the protective outer layer of our financial architecture. It explicitly lays out the issuer's obligations, sets up protective covenants to stop the issuer from doing anything reckless that could harm you, and firmly establishes the rights of the investors. And that brings us to the absolutely vital role of the trustee. Look, it would be a total nightmare for an issuer to deal directly with thousands of individual bondholders. So a trustee, usually a major financial institution, steps in to act in a strict fiduciary capacity for the bondholders. They are the guardians. They safeguard the collateral, invoice the issuer for interest, monitor strict compliance with that indenture, and most importantly, if the issuer defaults, the trustee holds the power to bring direct legal action against them on your behalf. When we pull back and synthesize all of this, a really profound realization emerges. Think about it. Whether you're looking at a U.S. Treasury backed by the full faith and credit of the government, a UK gilt, or corporate debt from global giants like Apple, Microsoft, Reliance, or Tata, every single instrument snaps perfectly into this identical standardized grid. They have wildly different issuers, completely different purposes, and risk ratings that range from AAA investment grade all the way down to speculative status. But despite all that, they all follow the exact same structural DNA. This simple, standardized contract is literally the economic engine of Earth. It connects massive institutional pools of capital, like your pension fund, directly to real-world development. It's the invisible force directing trillions of dollars to build the bridges we drive on, the hospitals that treat us, the research centers pushing innovation, and the power grids lighting up our cities. Face value defines the promise, coupon defines the income, and maturity defines the timeline. So, as we wrap up this explainer, are you ready to look past the surface of global finance? By finally understanding face value, coupon, and maturity, you now hold the key to the engineered matrix that literally builds our world. Next time you look at the infrastructure around you, will you just see concrete and steel, or will you see the 3 hidden numbers that actually funded it? Hopefully, by the end of this, you'll never look at a bond certificate the same way again. Thanks for tuning in, and keep looking for the hidden architecture in everything you see.